Tesla shares shrugging off, a pair of downgrades to kick off the week, jumping 4.5%. Analysts have been raising concerns over CEO Elon Musk's growing feud with President Trump. But our next guest says the war of words is far from the only obstacle facing this company. Former Ford CEO and CNBC contributor Mark Fields joins us here on set at the NASDAQ. Mark, welcome. It's great to see you in person.
Thank you.
For a long time, you've been a Tesla doubter, but now is a nail in the coffin, in your view?
No, absolutely not. Listen, from a short-term perspective, they face a lot of challenges. They face, declining sales. Part of that has to do with the fact that there's more competition now. 5 years ago, they didn't have a lot of competition. You see declining sales. You see declining margins. China is a big problem for them. It's a big market for them, and there's a lot of domestic manufacturers there. So, they have a number of issues, plus, on top of wrapped all around the issues with Musk being involved with the Trump administration. That being said, they have a lot of advantages, right? They have a cost position better than the rest of the industry. They have positive margins, which is better than the rest of the industry. And, they're launching the robotaxi business, which if they get that right with they're using cameras, they can have a big cost advantage versus somebody like Waymo, and then there's robotics. So that's the way I would characterize it.
Right. For a long time, we've talked about, in the bear case for Tesla, growing competition. And we are at the point now where that is nipping away at the edges. Can the big three, can other automakers actually capitalize on Tesla's woes, or is it so dispersed, those market share losses of Tesla amongst the competitors, that it's not really a win for anybody else?
Well, it is a win when they're gaining share. I mean, if you look at Tesla's market share of the industry 3 years ago, they had 85% of the market. Now they have below 50%. So that's a positive for the established automakers. The issue is going to be going forward is with tariffs. That is going to worsen the margins for the established OEMs. And in particular, if they sell a less amount of EVs, they have to meet fuel economy requirements. And if they don't meet those, they have to buy emissions credits. And guess who they buy them from? They buy them from Tesla. So in effect, they help subsidize the Tesla business. But net, they're gaining, but they have to get to profitability to have profitable growth.
40 years ago, Ford was a $10.50 stock. It's a $10.50 stock today. Understanding it's had some ups and downs along the way. What's the path forward for a Ford automaker in this environment? Because they're seemingly sort of mired in no man's land.
Well, Ford, as well as the other established automakers, are making a lot of investments in technology in their vehicles, right? Almost to make their computer on wheels. The market has never given them any credit for that. When I ran Ford, we talked about the investments we were making in autonomous vehicles, in EVs, in compute power on the vehicle. But the market tends to view established automakers as metal benders. Also, they have a reputation for destroying capital over the years. You can just see that with their over-enthusiasm on EVs. They have a lot of stranded capital right now because customers didn't come as much as their product programs and capacity did. So I think the path forward for folks like Ford in particular, they have great product. They have high appeal product, trucks, SUVs, making sure they double down on that. That provides a great profit stream, their parts and service business, and they can use that, as they're doing right now, to invest in EVs. They have from what I hear, they have a skunk works in California working on some innovative product. Their product appeal is really, really good. And I think that's the key for any automaker, is having fresh product. And that's one of Tesla's issues right now. Their product is aging.